Okay, let's dive right into this explainer. Today, we're tearing down the hidden mechanics of institutional order block and liquidity trading. We're going to decode exactly how smart money moves, and way more importantly, how you can avoid getting caught on the wrong side of those moves. If you've ever felt like the market was literally targeting your stop loss, well, you are in exactly the right place.
Think about this for a second. Why did your perfect order block fail? I mean, you've probably marked a zone flawlessly on your charts. Right area, right direction. You watched the price drop right back into it, confidently took the entry, and then, boom, stopped out anyway. And to add insult to injury, the market immediately reverses from a zone just a hair below yours and runs exactly where you knew it would go.
It is just an incredibly painful experience getting stopped out right before a massive move. It's this frustrating illusion of the quote-unquote perfect setup, and it traps everyday traders constantly. But don't worry, by the time we wrap up this explainer today, we are going to solve this exact mystery. We'll break down exactly why this happens and how you can fix it.
All right, let's set the foundation with Section 1, Decoding the Order Block.
So an order block is basically a highly refined supply or demand zone where a massive influx of institutional orders creates a visible price imbalance. The absolutely crucial thing to remember here is that order blocks highlight where the real smart money operates. When massive institutions enter the market all at once, they leave behind unfilled orders. The market almost always returns to these specific areas to restore balance, and that's exactly why we expect a strong reaction when price revisits them.
It's really the basic rhythm of the market. On one hand, we have supply zones. These represent the exact beginning of a downward move where we expect sellers to aggressively step back in. On the other hand, demand zones mark the start of an upward move where buyers re-enter. The market is constantly moving in these impulsive corrective waves and rhythmically reacting to these crucial areas based on what all the participants are doing.
So how do we actually spot them on a chart? Here's your practical game plan. First, you look for a fair value gap. This is just a rapid price move that leaves a very visible imbalance. Next, mark the entire candle that appears right before that gap as your zone. And honestly, the color of the candle doesn't matter at all. But here is the critical part. If the wick of that candle grabbed liquidity just before the imbalance, you have got to include that wick in your zone. That wick is exactly where you want to place a safe stop loss.
Next up is a term you need to know: change of character, or choke. This happens when price breaks below a protected low or above a protected high. Now, why does this matter so much? Because a change of character is your definitive signal that the market structure is shifting. It literally tells us that buyers or sellers have lost control, and a potential trend reversal is actively underway. We absolutely need this signal to confirm our bias before jumping in.
Okay, moving right along to Section 2, our multi-time frame trading plan.
To execute this strategy properly, you have to use a multi-time frame approach. The higher time frame is your main chart. You use it to find the overall direction and mark those key order blocks. Your lower time frame, though, that's used strictly for confirming reversals and executing precise, low-risk entries. The golden rule here is that your entry time frame should be at least 2 times lower than your main chart, so something like pairing a 1-hour chart with a 15-minute chart.
So here is the 5-step order block within order block blueprint that makes up the core mechanics of a smart money setup. Step 1, analyze the overall higher time frame structure. Step 2, mark your key order blocks. Step 3, wait patiently, and I mean patiently, for price to pull back to those zones. Step 4, drop to your lower time frame and spot that change of character we just talked about. And finally, Step 5, execute your entry on the brand new lower time frame order block that forms. It's super systematic and highly logical.
Now, when you enter, your very first goal is a 1-to-2 risk-to-reward ratio. Once the market hits this level, the smartest play you can make is to close half your position and move your stop loss right to break even. This kind of structured trade management ensures you actually secure those profits, all while letting the rest of your position run toward the major higher time frame liquidity zones.
But look, no strategy works without discipline. These risk rules, they are completely non-negotiable. First, never risk more than 2% of your account per trade. Second, keep a maximum of 3 trades open simultaneously just to protect your capital. And most importantly, remember that losing trades, missed setups, and small drawdowns are a completely normal part of trading. Even with a flawless plan, you are going to experience losses. Managing that risk is how you actually survive them.
Which brings us to Section 3, the big reveal, the smart money trap.
Let's circle back to that question from the beginning. What happens when price completely ignores your perfect order block? I mean, it just slices right through your zone without ever giving you that change of character on the lower time frame. Well, here is the big secret. There was actually nothing wrong with how you marked it. The cold, hard truth is that some zones are entirely designed to fail.
This intentional failure is caused by a concept called inducement. Inducement is essentially a market trap explicitly designed to tempt everyday traders into entering early positions strictly so smart money can collect their liquidity. Smart money intentionally engineers fake pullbacks, early breakouts, and totally misleading fair value gaps. They are actively trying to induce you into the market in the wrong direction before the real move even starts.
I want you to really consider this realization. It was not a bad order block. It was the order block you were meant to see. Think about that for a second. That first, obvious, clean, easy to justify zone, that is exactly what makes it so dangerous. Obvious setups are so often just bait for retail traders. It feels like a fantastic trade, but it's really just a trap.
So, we have to understand why this actually happens. It's simple, really. Smart money needs fuel. If price moves directly into a fair value gap without inducing early traders first, there's no liquidity. And without liquidity, the massive institutions have absolutely no fuel to reverse the market. The reaction from the gap ends up being weak and completely fails, because there just aren't enough retail stop losses to actually fund the massive institutional reversals. Inducement literally creates the necessary liquidity.
All right, let's talk solutions. Section 4. Escaping the inducement.
This is the core psychological battle every single trader faces. On one hand, you have the trap. That's entering early out of pure FOMO, the fear of missing out, because you desperately want a better price and you just can't wait for confirmation. Honestly, that feeling of being early is exactly the emotional reaction the inducement was designed to produce. On the other hand, we have the escape. That means waiting patiently for a lower timeframe change of character. It's the absolute strategic necessity of waiting for technical confirmation so you don't just hand your hard-earned money over to the institutions.
Escaping this trap requires incredible patience, right? And the absolute best way to build that patience is through strict trade journaling. When a really obvious zone fails, you have to resist the urge to just burn down and rebuild your entire trading model. Recognize that, hey, most of the time your overall market direction was perfectly right, but your specific entry location was just a bit off. Write down exactly which zone you were induced into and which zone actually paid out. Location errors are incredibly expensive precisely because they give you false confidence that you were close.
So as we wrap up this explainer, I want to leave you with one very important question. Look at your charts and ask yourself, are you managing risk or are you just funding the next move? When you place your stop loss just below an obvious clean low because it looks totally protected, are you actually safe? Or are you just standing right in the pool of orders that the smart money needs to sweep before they take the market higher? Challenge yourself to wait for that lower time frame confirmation. Rethink your setups, trade with unshakable discipline, and whatever you do, don't take the bait.